Hello BiggerPockets Nation, this is Jesse Fragale. We're coming at you with another commercial real estate investing video. If you're in any warm places, send some vitamin D because it is freezing here in Toronto. I was out with a lady today and just layered, lots of layers. Anyways, you didn't come for the weather, you came for real estate. So let's get into it. Okay, today we're going to be talking about risk. Not the game risk, but as it relates to real estate strategies. Last week I talked a little bit about the 4 different types of real estate categories when it comes to commercial. Talked about retail, multifamily, apartments, office, and of course industrial. Now a couple commenters said, well, there's also mobile parks. Mobile parks I would probably classify as a subcategory of apartments, and then somebody said storage, which is another great subcategory of industrial. Anyways, that's not what we're talking about today. Today we're going to be talking about the actual strategies that many investors use when looking at all of those different asset classes. So here we go. Okay, number 1, we're going to talk about core assets, a core real estate strategy. Kind of like how it sounds. It is major markets in the downtown areas, the downtown cores, CBD areas. Now this asset, as you guessed, it is the most conservative of the bunch. It's consistent. Cash flows aren't going to be incredible, but the tenants are going to be incredible. Now these assets are typically the best in a downturn. They're the ones that are giving you consistent returns, and in the long term, they are your good equity appreciation purchases. These assets, you're not going to be able to put much more in the way of increasing rents. They're pretty much at their cash flow maximum, not always, but that's usually the case. They're really a buy and hold consistent strategy. In terms of leverage for these assets, you're probably not going to get more than 50% of the asset value, and that's just a function of the fact that you've pretty much topped out in terms of what you can get for rent. Anyways, core, we like you, conservative, no problem. So core's younger brother, core plus, a little bit more of a risk taker, but follows in his brother's footsteps. Anyways, this asset class is maybe not your Main Street or center ice. It's extremely Canadian reference, my bad. But it might be that historical building, it might be the building that's a little bit outside of the downtown core, and it has a bit of value add opportunities. The yield on these might be a little bit higher as well. So Core Plus has the benefits of being very similar to Core, with a little bit more of the value add potential. With Core, as I mentioned, they're very credit-worthy tenants, where with Core Plus, you might have good credit tenants, but a little bit more uncertainty with the renewals or potential income of those investments. You might have an expiry profile, which is just how different tenants in the building expire and when. That's not advantageous to you. For instance, a lot of tenants might be expiring at one time. So with Core Plus, there's just more opportunity to add value to the investment. In terms of leverage with Core Plus, you're going to be able to add a little bit more debt onto these, but they still are fairly conservative. So you might be topping out on that 65% of asset value. Now I should mention, when it comes to Core or Core Plus, a lot of the purchasers will be pension funds, sometimes real estate investment trusts. The reason I mentioned pension funds is because real estate is an alternative asset. I don't know why I did that. It's an alternative asset. Now that could be also private equity, etc. My point is that with pension funds, they typically don't have a huge amount of their portfolio in real estate, maybe 10, 12% tops, depending on the pension. But conservative real estate plays in the commercial space would be Core or Core Plus. So you'll see them as a purchaser of Core and Core Plus. Now we're getting into it. The way I invest is I'm a value-added investor. I've been on the BiggerPockets forums, and I know many of you are as well. Just to summarize, value add are those entrepreneurial investors that look at a property and try to find the discounts. Now this could be a retail plaza that just lost their anchor tenant, where you can get the building at a discount, and you can put together a strategy for how you're going to take this low rent building and get it up to market rents. It could also be the way my partner Jonathan and I execute our strategy for multi-residential apartments. What we try to do is find below market rent buildings where there's enough rent that you can get satisfactory financing on it, and then you execute a strategy. Bottom line is that when you're employed a value add strategy, you are going in with a premeditated plan from taking a building from A to Z, or Z, Americans say Z. To me, value add is what real estate's all about. It's finding those hidden gems and turning them from a value add building maybe to a core plus building. In terms of the leverage with value add, this is where you can start getting a little bit more creative. You can start getting 80%, 85% of the asset value. You can start asking owners for owner financing, or VTBs, also known as vendor take-back mortgages. And we could probably do a whole video on those alone. But really, this is the area where I think entrepreneurs, investors take something average or below average and turn it into something amazing. And I think that's why we all love real estate. It's being able to look at a process at scale and seeing the changes and watching them happen. And if you can make some money during the process, hey, more power to you. This is the last category we're going to be covering today, opportunistic. Sometimes it's called distress, but people don't like calling it distress because it makes it sound like the real estate is distressed because it's distressed. Now that's not fair. Sometimes it can be also developers actually building apartment buildings, condos, commercial, office, retail. Basically, opportunistic is the most risky and it has the potential for the most return. These could be distressed assets, as in foreclosed assets, or they could be assets that are just completely decimated by vacancies. Think retail plazas, the smaller ones that have lost tenants, that would be opportunistic. Another one would be apartment buildings, C and B class in rough areas, again, where the vacancy could be high. Opportunistic investors can also employ very similar strategies to the value add strategies, but it's just on a more tricky property. I would not recommend opportunistic investing to anybody that doesn't have a special expertise in a certain market. Usually what we would like to see is that opportunistic investors are ones that have rolled out this strategy in different situations. For instance, in 2008, there were a lot of distressed properties that were purchased in the downturn. Now, the thing is, oftentimes people, when they're looking in the downturn, you don't know where bottom is. So you could be buying a property that was $500,000 at $150 and you're thinking you're getting a great price, and then it goes to 20. The way I like to look at it is opportunistic deals are probably the closest thing in the real estate world to options, where you can actually lose everything and more. Opportunistic are actually similar to what they call growth stocks if you invest in stocks. Now, I think there should be also a distinction made that opportunistic also includes development from ground up and purchases of land. So land purchases, just by nature, they're risky because they don't have income. And development, I mean, listen, I'm of the mind that developers and real estate investors are two totally different things. And I don't want to get any hate for that because I have a lot of respect for developers. I just think that they are doing something that's very different from an entrepreneurial sense than what investors are doing. I think at the end of the day, any type of development, although you can have proper analysis, you look at population trends, you look at current rents, I think at the end of the day, you are still subject to the business cycle and the real estate cycles. So there is some speculation. Now, I think the developers that have stood the test of time are the ones that can understand the business cycles to a certain extent because, you know, let's face it, we don't have a crystal ball in this business, but also have kept themselves well capitalized. When it comes to financing for opportunistic investments, it is a mixed bag. It actually goes the other way than with the previous categories in that it's harder, not surprisingly, to get financing on these. Now, this could be in the form of construction loans for development, mezzanine debt, which is debt that will be at a higher percentage rate than if going to a bank. The other thing that you have to think about is opportunistic investors sometimes find properties where you cannot put any debt on at their current state. Sometimes the debt will come as the strategy is being executed. That's why I say that you really need to be an expert when it comes to opportunistic strategies, in my humble opinion. Thank you. This is Jess Fragale signing off BiggerPockets. Smash the like button, leave a comment, subscribe if you're not subscribed. Why are you watching this if you're not subscribed? Anyways, I'm gonna go get a Tim Hortons coffee and a big sweater to deal with this freezing weather. Ciao.